the Bull Call Debit spread has the same risk-reward profile as a Bull Put credit spread. They are parity trades of one another. One is done at a debit and one is done at a credit. Right? But essentially what we're doing in a Bull Call Debit is I'm going to sell a slightly in-the-money call. The stock price would be a little bit above, and we're going to buy a deeper in-the-money call for a debit. So if I paid a debit of 310 in this structure, and let's say I sold a 35 call on a stock and I bought a 30, well, as long as the stock stays above 35, we can close out the position. Essentially, our broker will buy shares of stock for us at 30, sell it at 35, we get 5 points back. So in this case, we'd make $1.90. Okay. Now, the question that came in is, Ron asked, the stock has moved between the strike prices of my Bull Call Debit spread. And what he wants to know is, should I close the position before expiration? It looks like it expires next week. It's a weekly, excuse me. Should he close the position before next week or just hold it to expiration? Okay, well, this is an interesting topic, and the reason why it's interesting is because even though you traded a spread, you have to remember that what you also did is you entered into one obligation to deliver shares of stock and one obligation to potentially buy shares of stock if you don't close it out. Just because you did it as a spread does not change the rights and obligations of the two options that you entered. Okay, what do I mean by that? I'm going to take a look at eBay real quick, and I'm just going to go to the chain, and real quick I'm going to look at the stock chart. Okay, just going to go back in time here, and I'm going to pull it up, let's say around June 5th. Okay, I'm going to look back to about June 5th. Okay, eBay is currently at about $34, $33.98. So I'm going to use the historical features here. And we're going to go to June 4th or June 5th. Let's take a look at the price there. Okay, so on June 5th, eBay closed at $35.55. Now, I might have been bullish at eBay at this time. It looked like maybe it was having a good trend on a position. And let's say that we went out to the June 23rd series next week, 18 days out. And on June 5th, let's say we sold the 35 call for 95 cents. And at the same time, we bought the, okay, I'll use the 32.50 in this case, for about $3.35. Okay, so let's go ahead and go to our custom spread tool, build our position. So we'll just enter in the symbol here, and we'll select our options that are available. And let's see here, June 23rd series. I'm going to add in our 35 call that we would have sold for 95 cents on June 5th. And the 33 call, I'm sorry, no, not the 33, it was the 32.5 I used. I was going to use even strikes here at 250. Okay, so sell an at slightly in the money call, in this case for 95 cents, and then we bought the 32.50 call for 335. Now this isn't going to be a very high return position. It's only 4.2% or 10 cents. So let's say we got a little bit better price. I'm sorry, I'm going to bump this up to 105, and I'm going to lower this down to 315. Make it look a little bit better, but the situation is still the same. Okay, that's a little bit better. So 40%, 40 cents off of a 250 risk, essentially, or 40 cents off a 210 risk for a 19% return. But the max profit on the debit spread would occur if eBay ends above 35 on Friday's expiration. Essentially, if I did nothing and left the position open and the stock was above 35, my broker would have to deliver shares of stock for me at 35 that I don't own, but they would know to exercise my 32.5. So I'd buy stock at 32.5, sell it at 35, we'd get 250 back, of course, but we put in a debit of 210. So that would be our profit of 40 cents. Now, if the stock stays in this area, if it stays around $34 for the next 5, 6, 7 days through next week's expiration, and you do nothing, what happens? Your 35 call expires worthless. That disappears. because it's out of the money, but you still own a 32.5 put that you didn't close. So what does that mean? That means your broker would assume that you wanted to exercise this if you didn't close it beforehand. So on Monday, we just did one contract here in this example, but on Monday, with the stock between the strike prices, you would be long 100 shares of eBay at $32.50. Okay, but remember, you also paid a debit to get into the transaction of $2.10. So you're holding a stock at 34 that's trading at $34, and you've got a cost basis of $34.60. Okay, so you're still at a loss on the position. But just because you entered this long call as part of a spread, if it's between the strikes, you leave it open to expiration and don't close it out, your broker assumes you want to exercise that call. They won't sell to close it for you. They will exercise it, and you'll be long X amount of shares at this strike price. Okay, so that is the reason why in a bull call or a bear put debit spread, if you do the reverse, but if the stock's between the strike prices, you're going to want to consider closing out, selling to close that 32.5 call at some point prior to Friday's expiration, unless your long-term goal is to hold shares of stock of eBay at the 32.50 strike. Maybe you're planning on converting it to a covered call, a collar, or a married put, but in general, most investors who trade debit spreads have no interest in trading the stock. That's why they're in the debit spread to begin with. So in the situation where it's between the strikes, you can't be assigned early on this. You do own the call, so no one can force you to buy shares of stock at 32.5, but you got to keep in mind that if you don't close it before expiration, that long call is in the money, even though you opened it as part of the spread position. It's still a long call, and this is still a short call, so you're still obligated to maybe deliver shares of stock here at this strike, and you've bought the right to buy shares of stock at that price. So when it's between, you still have to fulfill the obligation. Side note, let's change this up a little bit. Let's say that on the same day, rather than doing the bull call debit spread, where we paid a debit to get in the position, let's say on June 5th we did a bull put credit spread for the 23rd expiration with the same strikes. It would have been a parity trade. Okay, but let's say we sold the 35 put and bought the 32.5 when the stock was at 35.50 or 36. And let's say we got 80 cents here for selling the 35 put, which was out of the money. We paid about 40 cents here for buying the 32.5. Okay, so this is a parity trade, has the same risk-reward profile. I purposely put in the same prices, so the credit is 40 cents. If the stock stays above 35 now in our bull put, both options expire worthless, we keep the net credit. But we'd have to put up the $2.10 margin requirement, the difference between the strikes, to cover the potential obligation of getting closed out. Why am I bringing this up? Because even though you did this as part of a spread, now that it's gone below your short put strike price, and what is the obligation of selling a put, regardless if it's in a spread? Well, the obligation when you sell a put is that you've entered into a contract where you may be forced to buy shares of stock at that strike price if the stock is trading below it. So what happens if eBay stays at $34 per share through next week's expiration with this June bull put spread and we don't do anything? Well, in this case, the 32.50 put would expire worthless. It's out of the money, opposite from the bull call debit spread. But our 35 put is in the money, which means if we did nothing, we have to fulfill that obligation. So on Monday, we'd end up being long 100 shares of stock at 35. And in that bear bull call debit spread, we would have ended up buying 100 shares of stock at 32.50 if we didn't close it out before expiration. So the idea is you'd want to close this option, buy to close your short put if you didn't want to own shares of stock. And chances are, since you were doing a leveraged spread position, you weren't interested in owning the stock. You were trying to profit on it long term. So remember, in the bullish or bearish spreads, if the stock is between the strike price, the outcome is likely that you'll end up being long shares of stock on the bullish spreads. Even in a bull put credit spread, if you let it go between the strikes and you don't do anything, you'll be assigned at the higher strike put. On the bull call debit spread, if it's between the strike prices, you'll end up buying shares of stock at the lower strike call. Bear put debit and bear call credit is reversed. If it's between the strike, you'll end up being short shares of stock. In the case of a bear call credit, where I sold a short call, let's say I sold a 32.5 call here, and I bought the 35, we'd have a bear call credit spread. Well, the stock's between the strikes, what's going to end up happening? My long call expires, but I have this short call here, which obligates me to deliver shares of stock I don't own at 32.50. So I'd be short 100 shares of stock at 32.50 with the stock trading at 34. So I'm down, $1.50 already. And in the, of course, bear put debit, you would have sold the 32.50 put and bought the 35. So the 32.50 would expire, but this long put, same thing. If you hold it to expiration and do nothing, what does that mean? Well, holding a long put means you're forcing someone to buy shares of stock for you if you don't close it before expiration. Your broker would exercise that put. You'd be short 100 shares of stock at 35. Okay, so just remember, even though you're doing a leverage spread and you entered it as a spread position, you still have an obligation to do something at the short option strike price, and you have the right to do something at the long. But if you don't close it before expiration, you may end up buying shares of stock at the long call strike price for a bull call debit, or of course being put stock on the short option strike in a bull put credit. So you want to make sure that you adjust that before expiration. Real quick, for those of you who are interested in some of that, the management techniques, remember anytime you can go to our webinars page. It's a free page. It's www.poweropt.com/webinars.asp. I'll just send that to everyone in the link. Oh, sorry, 1 second here. Okay. All right, sorry about that. So in the webinars there, and then if you go to option strategies, you'll see that there are several webinars on managing different things. Here's one on managing your bear call spread. There's one further down on managing your bull put spreads. There's also ones for naked puts and covered calls. But these ones here talk about the trigger points. Okay? And what I mean by the trigger points is the fact that what would I do so I would maybe manage or close or adjust the position before the stock went below my short option strike price in a bull spread where I'm starting to lose money as well. Okay? Okay, Lauren says, I'm sorry, Lauren, yeah, it says your example shows a call debit spread and you talked about a put. They're parity trades of one another is what I was showing, Lauren. I'm sorry if that got confused. I went to the second one to show that in the custom spreads. A bull call debit spread is a parity to a bull call debit spread. They have the same exact risk reward profile, likely the same price, okay? But in either situation, Lauren, if you're in a bull call debit spread, or you're in a bull put and the stock is between the strike prices and you don't close it before expiration, the outcome is you're going to be long 100 shares of stock. Okay, in the bull call, your broker will exercise that long call that's at a lower strike price. You'll buy shares of stock at the lower strike because you didn't close it and the broker assumes that you wanted it exercised to own shares of stock. In the bull put, it has the same risk reward profile, but when you sell the put, you enter into an obligation. So if the stock is trading below there and you don't close it out ahead of time, you'll be assigned at that 35 strike. Okay, so the concept here is that either way, even though you did it as a spread, remember, you may still end up owning shares of stock at a particular strike. So yeah, I know, I'm sorry I was mentioning two different things there, but they're essentially the same trade. Let's take a look at a current example. I'll just do it here. Okay, so let's say, not interested in this trade right now, but this goes into Sam's question. He was talking, I think, about Apple a moment ago. Okay, let's say today, bullish on Apple. I'm going to go 14 days out in time, Lauren, and I'm going to do a bull put. Now, usually I'd look up the probabilities, of course, and I'd want maybe a 70-75% probability of expiring worthless, so I'd look for an out-of-the-money strike that has that probability, and I'd have a requirement. We're just going to do a quick example. Apple's currently trading at 142.27. All right, so let's go 4 points down. I'm going to use a 5-point spread. I'm going to sell the 138 put for 86 cents. Okay, and this closing price is today. So 138 at 86. And we're going to go to the 133, a 5-point spread. Perfect. And we're going to call that 32 cents. Okay, so in a bull put spread, I'm going to sell the higher strike put that's out of the money, and I'm going to buy the lower strike put. We're going to use midpoint prices based on that chain. So today I could have opened a bull put credit spread by selling the 138s at 86 cents and buying the 133 for 32 cents. So we're going to get a little, sorry folks, there we go. So we're going to get a little bit more than a 50-cent net credit. So we're going to have about a 12% yield on this position. 54-cent total net credit for this bull put credit spread. As long as the stock stays above 138, both puts expire worthless, we keep the net credit. But I have a 5-point spread, so I'd have to put up $500 to cover if the stock dropped below 133. I have to cover the 5-point spread, so my broker is going to require me to hold that on margin in my account. Now, if bull put spread again, let's say Apple goes suddenly below, and we'll say it's trading right at 135. And I do nothing on June 30th. The stock closes at 135. What does that mean? It means I've got a 138 put that is in the money and a 133 that's out of the money. 133 put expires, and I'd be forced to buy 100, 500, or 1,000 shares of Apple at 138, depending on how many contracts I sold. And if I did 5 contracts of each, I'd have to buy 500 shares at 138. So come Monday, that would be my obligation. I'd be long 500 shares of stock trading at 135 with a price of 138. But I still keep that 54-cent net credit. Okay. Now, let's do the parity trade. What's my break even? 137.46. Max profit on our bull put spread is if the stock's above 138. Max loss is below 133. Let's see what a bull call debit spread would be with the same strikes, which means it would have the same probability of success, staying above 138. So we'll go back to our chain. We'll go to the June 30th series. I'm going to sell a 138 call, 520 midpoint. I'm going to buy a 133. Let's call it 960 to 1020. So we'll call that 60 cents. So we're going to put this at around 990. Okay. This doesn't look as good, but that's going to be our prices. So we're buying the in-the-money 133 call for 990. And we're going to reduce some of that by selling the 138 call for 520. And if I did it correctly and selected sell as my action, we would see the proper profit and loss chart. There we go. All right, so now this one, not as attractive in this case. Tried to use midpoints, but see, I'm paying a debit of 470 to enter this position. And what happens if the stock's above 138? Well, I have to deliver shares of stock I don't own at 138, just like I had sold a naked call or a covered call. But I bought the right to buy shares of stock at 133. So my broker would buy 100 shares of stock from me at 133, use that to cover the obligation at 138. I get 5 points back, but now I'm only making 30 cents, whereas in the bull put, we were going to make 54 cents for a 12% yield. Okay, so in this case, looking at the numbers, and this was trying to get as close to midpoint as possible, I'd lean definitely to the bull put spread because it's doubling my return. But let's take our example one more time. This is the bull call debit. And what happens if the stock falls and is trading at 135? Well, that 138 call expires worthless. But if I don't close the 133 call before expiration, my broker assumes that my intent was to buy shares of stock. So come Monday, this first, second, third, well, yeah, it would be a shortened day on the 3rd, but at July 3rd, I would be long 100 shares of stock at 133 because I have a long call that I didn't close This is the bull call debit. So my broker would assume I'd want to buy them at that price. Okay? So I know I got confusing a little bit because we're talking about two different things, but they are parity trades. Both of them make the maximum profit if the stock is above 138. Both will have the maximum loss if the stock is below 133. Usually you'll see a imparity, I don't want to say that, non-parity, but usually you'll see that either the bull put or the bull call debit offers a higher return with midpoints, and that's typically the one you want to go with. So if I like the probability here at 138 on Apple and I was bullish, I'd have gone with the bull put credit spread because almost doubled the return, 6.4% versus 12.4. Other times you'll see it opposite on other stocks. You'll see the bull call debit has a higher potential return than the bull put credit. But they're parity trades. They have the same exact risk-reward profile, same exact probability. All right, let's get to Sam's question now. And Sam had a question related to how to decide when to sell your stocks when your put protection expires and the stock keep on going lower. Okay. All right. This is the example on Apple. So Sam was playing around with some kind of married puts or covered positions, protected positions. Okay. And he wants to know, when do you know to get out of the position? Okay. Well, let's take a look here. One follow-up question. I'm sorry. Guy asked a question. He says, for a bull put spread, does the fact that you keep the premium make it better than the bull call spread when one of the leg gets exercised? Okay, let's pause here. I'm sorry. I'm going to stay where we are right now for this one. Remember, the net credit on the bull put was 54 cents. Okay? If I had done the bull put, we had a net credit of 54 cents, which was about a 12% return. Now in our example, we said that the stock was trading at 135, and we did nothing. Okay? But let's say we held it to the last minute before expiration, Guy, right before the close. And remember, we're short the 138 put, and our 133 expires worthless. In this case, we're in the bull put now. So with the stock at 135, what am I going to have to do? I'm going to have to buy to close my 138 put for $3. Okay, so the max loss was on the bull put credit spread, was 446. So I'm not at the full loss, but I still got to pay $3. Yes, I keep the net credit. I pay $3 back, so I'm going to end up with a loss of $2.46 with the stock at 135. Not the max loss of 446, but pretty much half of it in this scenario. Okay? So that's the bull put loss if I had to buy to close the put at 138 and got close to intrinsic value. Reverse it. I'm in the bull call debit and the stock's at 135. I paid a debit of 470 in this case. Okay? But remember, even though I paid a debit of 470 and my 138 call expires worthless because it's out of the money with the stock trading below it, my 133 is 2 points in the money. So I sell to close the 133 call for $2 and I take a loss at 270. Okay? So this one looks better now, but remember it's better because it had a 54-cent maximum profit compared to a 30-cent maximum profit. What if our bull call debit that we're looking at here had a lower debit that was more equal to parity, meaning that let's take this up to 24 cents, so we'll get 544 for this call. Let's say we sold the 138 call for 544. Now the two are at parity, right? I have a debit of 446. We're on the bull put. I had a margin of 446. But here we go. Stock is at 135, June 30th expiration. I did nothing. I paid a debit of 446, but my call is still 2 points in the money. We've got the 133. That's still 2 points in the money. So I sell to close my 133 call for $2 and have a loss of 246, the same exact loss I would have had I had to buy back the 138 put with a 54 cent. Essentially, it's even. If the bull put is offering a higher net credit, that means that you have a lower maximum risk and a lower margin requirement. And it would be a better trade. You'd have a higher return. So we would have gone with the bull put. You're right. with 54 cents versus 30 cents, I completely agree. But if they were close to parity to begin with, closer to parity to begin with, if one was a 10.8% return, one was 11% return, if it's anywhere between the strike prices, the loss you take would be the same on, pretty much the same on either one. Okay, so it wouldn't matter. That's the definition of a parity trade. But we talked about the imparity because the bull put actually gave us a credit of 54 cents where the bull call did not. Okay, all right. Sam, let's go back to what we were talking about here with Apple. Here's what I want to do. Now, what might have happened here is that Sam might have had a lower cost basis on Apple because he's been trading it for some time. Let's call it 121 or so. Okay, and over time he might have bought a put that was expiring today, and let's say he bought at some point the 140 put for about $4. Okay, as the stock moved up, you know, he's been doing other trades and spread positions against this, and he's also been doing other positions, selling calls, doing so forth, buying calls too. Well, this was a bulletproof trade, okay? So let's say that at one point he had this bulletproof trade with a stock at 142.77. Now he's saying this put expired worthless today, okay? It was below the strike price. It expired worthless. So Sam's question, and I don't know if this is right for everything, Sam, but I've got two examples of what I should have done and didn't do it either, that I would have followed this rule. I am a fond proponent of using MACD as well as Bollinger Bands as part of my analysis for a stock. The Bollinger Bands are shown here. This is how I've set up my chart on big charts. I'm looking at the Bollinger Band envelopes. The 20-day moving average is the yellow line between the two Bollinger Bands, and I'm using the MACD as well. Okay, so the MACD line is here. Now what do I look for when a bullish stock is on a run? I look for this crossover, okay, where the blue line, the MACD line, crosses over the signal line, and at the same time my stock's showing a move above the 20-day moving average and getting closer to the upper Bollinger Band. This would have been a double buy signal for me personally here, so I probably would have gotten in around 145. Where's the trigger to exit? Now we might have missed this because this looks like a, I got caught on this with AEIS, you know, the tech thingy, whatever this tech thingy was, okay? So let's say we had that 140 put and the stock was up here at 155. I might have gone up a little bit higher here to try to ensure some more, but I don't know what your exact position was, but that's okay. So we had that ridiculous drop down. And this was that little tech jump that we had down. And we see here that things are starting to get interesting right here. What is this? This is a reverse crossover on the MACD. But it still looks okay. But once I saw this anyway, and I know it came back up, but usually when I see a position where the MACD is negative and it starts to breach below the 20-day moving average, that's sort of a double bearish signal. Yeah, sure, I want to stay in the position longer, but at this point what I might have done is added extra insurance. When I see a crossover to the negative and weakness, and then it starts to dip below the 20-day moving average, I might have added a 150 put here on that signal, personally. Okay, so yeah, it would have looked very bad, but then there was this drop, and then this drop, and it's still going down. See, this is what you're worried about now. The MACD has gone negative below the what's called the divergence line, but the MACD has gone below the divergence line. The signal line is started, the EMA 9 is starting to drop below I can't speak, divergence line as well. So this does not look like a good chart. It's still going down. So here's another simplistic way of saying it. Someone mentioned in here you should use stochastics. Okay, and that's another way to read the stocks. You're absolutely right. And you know, so if this 140 put expired today though, but you're still in the stock, and this is showing me some negative, I might add a 145 put. And if it settles down and starts to come back up, well, I can convert this down, or I could convert that 145 put up, depending on what the stock does. But this doesn't look like a promising trend right now. The stock I mentioned around the same day, but it worked out for me because I was in a different position. It was AEIS, Okay, it'll be on the exact same date. We'll see the exact same chart. But I had sold, I got lucky, honestly. I hate to say it that way. I wouldn't call it lucky. But I had sold an 80 call for today, and I've got a 75 put for July. So I'm in a protected position where I'm bulletproof. I have no risk to the downside on AEIS, and this is about a 9% return if I was called out at 80. I didn't want to roll it up to the 85 again when it started to do this move. You know, it breached that MACD right here, and it started to hit the top Bollinger Band. I should have closed the 80 then, but I didn't, and it went above 85. But then that happened. And so here is the crossover. There's below the 20-day moving average. Now, I didn't add an extra put. It's at 72 now, 71.86. I didn't add an extra put here because I'm still holding the 75, which is still a guaranteed profit on this position with the married put trade. But at the same time, my 80 call expired worthless, but I could consider selling a 75 now, but I got to wait for another trend. If this reverses and moves back up, I'm going to wait for it to go to 73 or 74, and then I'm going to sell the 75 call or maybe the 80. Okay, so, but that's a signal I could have used, but I already had the put in place, and it's out to July, so I wasn't worried about it, and I'm a guaranteed profit. Someone asked, what do you mean by a guaranteed profit? Let's see what Sam's follow-up question is. Okay, good. I'm sorry, you did buy the 145 put, say, 3 months to expiration. I'd expect maybe the tech to settle a little bit next week, but that trend right now is still pretty strong to the downside. I doubt we're going to see a jump up on Monday, but I could be wrong. But I just don't feel the sense that the tech's going to say, oh, I'm sorry, we were wrong. Let's all go back up 4 or 5 points on Monday morning. It could happen, but I doubt it. Yeah, and wait for earnings. Absolutely. You've got earnings coming up as well, okay? Yeah, and you're also talking about getting the dividend and getting out of 140. Okay, so talk about Ron's question. That was the bull puts. Lauren's question was clarification of the bull call and bear puts. Sam's questions we just talked about. I'm sorry, folks. Yeah, so this is what I look for trigger points. Okay, so all along this line, this was deceiving. Sorry, I jumped back on there like that. This was deceiving with AEIS because it was middling about, but I was still happy in this range. But there was the first crossover here, and waited for the stock to move up. I actually did sell the 75 call here, and it looked good for a moment, and then what happened? It just accelerated again. But at this point, was it good for me? Because it dropped back down, I was able to buy that 75 call for cheaper, and then I rolled up to the 80, and then it just shot up again. Okay, but then it double crossed down, so I made out on the 80 call. But those are the signals I look for, the MACD crossover with a confirmation of the 20-day moving average or the Bollinger Band. When I see it break above the band and I just had a recent crossover, usually look for a stock to continue to move up. Of course, at earnings, around earnings, throw everything out the window. We don't know if it's going to be positive or negative. These were not earnings related. This was just that, I wouldn't call it a mini tech bubble, but the tech got destroyed for that 3 day period. Well, it's still going down, I should say. And see, here we are with the crossover and now at the lower band. So to me, this is telling me it's still primed to drop further. I might actually buy another put on AEIS. That's not a bad idea, Sam. I might buy a second 75 put on AEIS on Monday. And then if it drops down below that, I can close one of them out. And if it comes back up before July, sell another call. Okay? All right. So yeah, you said you made huge profits there on that one. Okay, I'm sorry. So other question from David was, what do you mean by a guaranteed profit? Okay, the way that we trade AEIS, the radioactive trading techniques, I originally bought stock a long time ago on AEIS when the stock was at 56.90, I think my price was. And at the same time, I think I bought, it would have been a July, oh, wait a minute, hold on one second. I can tell you. Let's see here. Okay, so I'm going to radioactivetrading.com. I'm going to go to the open trades here, and let's go to AEIS. So it's 56.80 and July 60 at 7:30. That was my original position. Okay, July 60 put at 7:30, and this was done back in January. Okay, so about 6-7 months ago. So it was originally a risk of 6.5%. Was the most I could lose on the position with an investment of 64.20. Stock's been as high as 85, but as you see, it's pulled back down in a 4-day period to about 71.86. Now, over time, of course, I kept adjusting this. I'd sell calls, Sometimes they expired, sometimes I had to buy them back. That's the original structure, but I also rolled up the put. You saw I'm holding a July 75. So yeah, it's a huge run. I think it's up 32%. Well, I'm sorry, it has been up 42% when it was at 80, from 56.80. I'm sorry, 56.80 when I got in, to when it was up at about 85.40. I think it was the highest recently, and I thought that came out to be a 42% gain over that 6-month period. In any case, so you saw that I made adjustments. I'm now holding the July 75. So we rolled it up and paid a debit, which increased my cost basis. So I think this has moved up to 66.80, and I'm holding a July 75 put, which I paid. No, I don't think it was that high. Maybe it was 63.80 is my new cost basis for the stock. But I'm holding a July 75 put for about 350 later on at some point. Oh, must be 66, sorry. Okay. I'm sorry, I forgot to factor in one of the long calls. I had to buy back short calls. Yeah, so it was a bulletproof position, but it still was, when it was up at 85, I was still earning, profits $1,600 against a $7,000 investment, but it's pulled back. So I don't want to say I'm almost at break even. I'm still guaranteed a profit. That's what it means. Okay, so my 80 call expired worthless today because it had that huge drop, but it could drop to 50. And because I only have a cost basis of 70.30, including all of my adjustments with the 350 put, even if it goes to $54 per share, I'm guaranteed to get 75 back in July or anytime sooner, and I've locked in a profit of about 6%. Okay, but I'm hoping, I don't think it's going to happen on Monday. What I am hoping for this stock is that the tech rallies a little bit more. I'm hoping this will go back up to 78. I know that seems like a lot in a few days. This stock has done it 5 times to me in the last 6 months. 3-day periods movement, not here, back in April, but you see this one here, the stock was right around 72, and within 3 days it was above 75. And this one here was trading right at 75, and 3 days later, 4 days later, it's right at 80. And then, of course, here it just breaks above 75, and 3 days later, it's up above 85. So this stock has the potential to do it, so that's what I'm looking for with this one to get it back up. I'm going to sell another call there, try to get a 9% profit out of the, more than 9% profit out of the position. What hurt me the most on this position, by the way, was selling calls. If I sold a 70, let's say here, because it was a really good, well, not here, I didn't sell it. Yeah, no, here. Yeah, when the stock was around 65 or so, I sold a 70 call here, and you see what happened. This was the expiration date, and just shoot, I bought it back here, but it was really expensive and rolled it to 75, and then it just went up again. So that's when I rolled to the 80, and it looked like it was going to get assigned at 85. I mean, the stock was going to stay at 85, it was going to be assigned this month at 80, and thankfully it pulled back, but I did pay, received about $1.40 for the 70 call here, and then had to buy it back for $3.80. So I actually added a cost basis of $2.40 to the position, and the same thing happened here, where I rolled up to the 75, got about another $1.40, but ended up paying about $3.90 to buy it back because it shot up so quickly, and then rolled up to the 80, and I was going to have to pay $4.20 to buy that back, and then the stock fell. So this just should have just left it alone, but sometimes you sell the calls, okay, and that's what happens. All right, let's see. Okay, sorry, Sam was saying he's in BA as well, Boeing, at a cost basis of 180. Let's see here. I haven't seen BA in a while. Similar protected position, but he's doing other adjustments. So it was about 196.44. And Tesla's 247 was your cost base, and you're still in that one as well, I believe. Okay. All right. So there you go. Yeah, Tesla's at 371. Okay, so you're locking in just like this, locking in some of that gain where you have no loss on the position. The stock could collapse 20, 30, 40%. You're still guaranteed a profit. That's part of the married put setup we talk about. Okay, that's the married put radioactive trade. We set up the initial position where you have the limited risk, and then eventually you can lower this gap, or if you have an underlying gain in the stock, you can put it in a position where you still have unlimited upside, but a guaranteed profit to the downside. And you can still do regular adjustments, sell calls against this, or do some of the spreads against it as well to lower the cost basis on the position. All right, Tony said you had mentioned 75% probability for spreads. Tony says that he looks for spreads with 90% probability or more, but he's had trouble finding them on the weekly options. Yeah, when we're talking any kind of credit spread, a bull put credit or a bear call credit, even the parity debit spreads, you can find spreads that will have a 90% probability for a 5-day trade, but likely it's not going to match your minimum requirement for net credit or return. Now the PowerOptions tools will show you those spreads if they exist, but let's take a look. So I'm going to go into bull put credit, and we're going to go into search. Okay? All right, so if we go into the search, what we're going to see is the listing of the bull put credit spreads that match our default criteria. Okay, now the default criteria that Ernie set up go 14 days out in time. He describes why down here in the description for this bull put spread. After testing it for extended periods of time over a 1.5, 2-year, 3-year time period of different criteria he's playing with, he actually found out he got a higher return using 2-week out options than the 1-week out. The reason why is because you always get a lower net credit for the 1-week option. The idea is, of course, you get a higher annualized return. But you're always going to take losses, even with management techniques and exit strategies. And he found that what he saw in his testing, using the 7-day out or the 5-day out options, because the premium was a larger percentage less, 40% less or 50% less than going 2 weeks out, the losses compounded faster. Even if you had an 85% success rate, the losses wiped out more previous wins because you were only making 10 cents or 12 cents or 8 cents 7 days out, where you're making 35 cents or 40 cents 14 days out. Now sure, annualized it looks like a higher return, but when you factor in losses occasionally, it looked like the 2-week outperformed the 7 days. In any case, Tony, here's what we can do. Let's go into our bull put credit spread. And am I in bull puts? Yeah. I'm going to clear filters. Right? I'm going to empty everything out of the parameter field for these options criteria, stock technicals, and stock fundamentals. And now what do I want to do? I want to look for just next week's expiration. So I'm going to leave this at all expirations, and we're going to go 1 to 8 days out in time, all right, or 2 to 9, somewhere in that time frame. So I'm just looking at next Friday's expiration. I'm going to put in my probability range down here, the theoretical probability that the stock would stay above the put strike prices. I'm going to use Tony's number of 90. But at the same time, there's some other things I want. Number one, I want to make sure that it's actually a liquid series. That's not a sort of a fly-by-night or just a small company that doesn't have a lot of option volume. So let's put in an open interest of 10. I'll put an option volume today of greater than 0 as well to make sure some contracts have traded. But now what? Well, you got to have some requirement for a net credit. Even if you're planning on doing your 20 or 30 contracts, you're probably not planning on trading it if it's trading at 1 cent. All right, so let's put in a minimum net credit of 5 cents for a 7-day trade. And that seems low, but I'm going 90% probability. This means I'm probably within the range of 3 to 4% of the money. I can't expect more than 5 cents if we can even expect that. And percent return, let's just try, but we'll go 1%. Okay, so I'm just looking for anything that's next week, has some reasonable open interest and had option activity today, bull put spread with a 90% probability minimum of a 5-cent credit. Let's submit that. Adobe, FedEx, there's 387 here that have a 90% probability. Well, here's a 52-cent net credit on a 3-point spread. That's not too bad, but I know something right away that you don't know. Okay, and it's because I'm trading, been practicing. I've been actually trading another strategy here using weekly options for long straddles where I buy the position 1 or 2 days before earnings and close it right after. I know Adobe, FedEx, and I think even CarMax have earnings coming up next week. That's why these premiums are so rich, where you wouldn't expect to see a 90% probability 5 days out with a $1.13 net credit on a 7.5-point spread, or 52 cents on a 3-point spread with a 90% probability on Adobe for a 7-day trade. And that's because they're inflated, because earnings coming out next week. So I'm going to go to the fundamentals. I'm going to try to remove anything that has an earnings date between now and expiration. Okay, so now what do we see? What I expected to see. Tesla, why? Well, because it has higher premiums and it's always volatile. Sam can attest to that. And 2 times and 3 times ETFs. Why? Because they move 2 to 3 times the normal ETFs, they're more volatile, which means enriched premium, which means you're getting the higher percentage there. It's a chance on these gold ones, because if it changes, 8%, 9% movement in a 2-day period is not unexpected for a 2 or 3 times ETF, just like it's, you know, an 8%, 7% movement maybe is not that unexpected for Tesla. It was down about 1.4% today, I guess. Walmart's interesting. Oh, why that's in there. It's a 15-cent net credit with an 11.1% return, but with a 92.2% probability at 73.50. Again, I wouldn't touch that. Why? Well, you know, all those companies took a big hit today. You know, anything with the Amazon buying out Whole Foods. Kroger's an interesting one. That was one of the long strangles I did. I think I did it at the 30 strike. And yesterday the stock, after earnings, dropped down to about $26 or so. And then today it dropped another 3 points because of the buyout of Whole Foods by Amazon. So had I held that straddle to today, I'd have had a 30 put that I paid $1.50 to get into total between the call and the put, that I could have closed the call for almost $9 today. So that would have been a fantastic return for a 4-day trade, but I didn't expect that was coming out. So I took advantage of the decline with the earnings, but then didn't stay for the extra day, because who knew Amazon was going to throw the whole thing into a loop with the sort of grocery stores and food packaging stores by doing this move with Whole Foods. Well, they knew it because they'd been probably planning on it for months now. You can't just do a $13.7 billion deal and, hey, with a quick phone call of 5 minutes, but someone was planning it for a long time. Okay, but here's what I expect to see. When you look for very high probability, very short-term credit spreads or debit spreads, you're going to see, if they're out there, this tool will find them. What I'd expect to see is things that have 2 or 3 times ETFs or very volatile. It wouldn't also surprise me if some of the, I'm sorry folks, some of the biotechs came up here, like Clovis Oncology is a really high volatility right now. I think you can buy the stock at 59, and I think the July 55 call is selling for about $11 or $12. It's got a phase 2 trial, I think, coming out in the next 2 to 3 weeks, which means the stock could go up 30% if it passes, or it could drop 40, 50, 60% even more if it fails on the drug trial. So that's not a position you want to do a covered call in, even though there's a $12 premium for an option that's 4 points in the money for a 30-day trade. It could work out very well for you, but it could also result in a high loss even with, excuse me folks, even with a 14, 15% downside protection in place. All right. Okay. So it looks like, oh, Sam was just talking about his bull put on Tesla. We were talking about bull puts earlier, where sometimes it has ended up. Let's take a look at Tesla real quick here. That's, yeah, not too bad there. It's still, you know, as far as it took a hit today, we saw 1.5%, and it's down again overnight. It looks like down to 370.20. But it didn't look like it got hit as bad. Yeah, it was 10, 15 points, but it didn't get hit as bad as some of the other techs that we were talking about, you know, Apple, AEIS, not even saying AES is that big, but that whole sector. And Tesla had its bounce arounds in there too. All right. But again, that's all the different strategies. You can set up the criteria specifically as you want. So if you have a specific requirement for a covered call, let's say you wanted a covered call on a stock that paid a dividend of at least 6% and offered a 3% return for a 2-month out, well, if that exists, this tool will find it. So you can just plug that into the covered call. Say, just go to the search again as we did here. And we've got default searches for you to use as a stepping stone, even the picks of the day that Ernie back tested and we saw the results for naked puts and covered call. Here's our search that we ran a couple of weeks ago during a webinar. What are we looking at here? We're looking at weekly covered calls with a minimum 0.5% return, it looks like. stock above the SMA 20. Sorry, just trying to, oh, and MACD. This was a MACD test. We were looking at ones of the MACD list. But again, let's just say I wanted to trade covered calls for 2 months out to standard August expiration, where I want a return of sign of at least 3%, and downside protection of at least 4%, on stocks, you know, that maybe are in my price range of, let's say, $2 to $150, but at the same time pay at least a 6% annualized dividend or more. Okay, and there's 15 of them. Macy's, I don't know if that's the best idea right now. Seagate, Tailored Brands, Suncoke Energy Partners, ETP, Energy Transfer, and Abercrombie, which has also taken a hit as well too. But the static covered call offers that minimum return I'm looking for, and all of these here have a dividend of above 6%, 6.1, 6.4, 11.1 for ETP, I bet. Yeah, 11.1 for ETP, and Suncoke Energy is the 14%, and Navios Maritime, I didn't know they were paying a 16% dividend. Okay, all right, and here's that field. We saw it with the bull puts when we were looking at probability. Well, that was looking at the probability that the stock would stay above the short put strike prices, both options would expire worthless. Here on the covered call, you're looking at the probability of being assigned. For this Taylor Brands at 1127, the August 10 strike at 160 would be a 3.4% return, and there's a 70.9% theoretical probability that it will be assigned, meaning the stock will remain above $10 at August expiration. Guy wants to know, how is the probability calculated? The probability is a standard equation that's used based on the past 52-week trading range of the stock. Okay, so we look at the past 52-week trading range of the stock, then we apply one standard deviation to those values, which allows us to apply a bell curve. And of course, the bell curve with the different prices here. So this is a bad example. Let's take CTech here at 4203. Okay, so here's 20. Here's 42. Here's 45, and here's 47. Anyway, so you get this bell curve. And with a stock at 4203, right here would be about a 50% probability at 42. Or what some people might say, it's got a delta of 50 or 0.5. What does that mean? Well, the stock's got a 50-50 shot of going above 42 or below 42 within the next 63 days, okay? But how is the probability for the other strikes? Well, it's probability in or out of the money. So in this case, if we're looking at this stock at 20, the probability of assignment, the probability above, is actually going to be 80, 90, 70, 60, 50, and it's going to drop down like this. It's not going to be more of a bell curve. It's going to be sort of like this. Okay, this would be the probability assigned on a call. And right here at 42, you're at 50%. Okay, for Seagate. At 20, I'd say we're probably looking at about 92 or 90, actually it's probably closer to 98%. At 30, you're probably looking at 96. Now at 35, might be looking at about 89% probability above. 37 is probably around 70, 72. Okay, and then 38 would probably be around 65. 40 would probably be around 60. Okay. Am I guessing? Well, sort of, but at the same time, let's take a look. Okay, I'm just sorry I got to leave these yellow ones here for the time being, or I'll erase everything. But let's go to August for Seagate. Oh, there it is. All right, so the 40's at 65, the 39's at 73, the 38's at 86. Okay, so I said the 38 I think was, oh, wow, these are much higher actually, lower volatility. But that's how it's sort of calculated. Okay, Guy, it's based on the 52-week trading range of the stock. So we're talking about the calls here and probability assigned. This is 50, this is 100, this would be 0 for if I'm doing it, sort of drawing it the other way. But here we're at 42. Okay, so that's right on the money. 50.2% probability above a delta of 0.53 roughly. Okay, and then the in-the-money calculation, it goes to 38. Let's say here, no, it'd be here, but 38 is at 80.6. Okay, but same movement, 44 is a 36% probability of the stock being above 44. And 46 we're at 24.3. So, but it's calculated for both. That's what I meant by the bell curve. So it's a 24.3% probability above at the 46 call, which means it's a 75.7% probability below. Right? But it's based on the past 52-week trading range of the stock and taking one standard deviation of those values to sort of plot that bell curve and then get the probabilities on the position. Okay, and that's also, you know, it's not exactly the same equation as delta, but you see here that for most stocks they're pretty close. Okay, it's not the exact same equation that's used, delta and the probability, but they usually end up being pretty close. Some services, as you know, as your broker might even do this, they don't show probability, they might just show delta and tell you that that's the probability. Subtle differences, but they're not exactly the same, okay, as a snapshot rule, but that's how the probability is calculated as well. Okay, well, it doesn't look like we have any further questions right now. I don't see any questions come in. We are at 5:33, whoops, sorry folks, we're at 5:33 p.m. Eastern Time. If anyone has any last minute questions, I encourage you to go ahead and send those in. We've still got maybe a couple minutes we can spend right now. I just want to remind everyone, however, that if this is your first time coming to one of these webinars, you came from the email invitation. If you like some of the tools that we saw to find those positions with the higher probability, analyzing the positions, of course, that search tools available for 23 of the most commonly used option strategies, as you saw. We saw the strategies that were available earlier. But in any case, if you haven't done it yet, you want to test out the tools on PowerOptions, just go to PowerOpt.com. You can just put in your first name, last name, and email address. No credit card required, and you can test the tools for 14 days for free. Okay, and of course, anyone who's on a trial with PowerOptions, you can schedule a coaching session, or you can call the office at any time or send us an email with any questions as well. PowerOptions, we of course are a subscription service, so our lowest subscription cost is $40 to have access to the tools, but that's for end-of-day service, so it's only updated at the end of the day. We do offer a 20-minute delayed service, which is $60 per month, and of course a real-time service, so every time you run one of those searches for the spreads or for the covered calls or anything along those lines, you can literally sit there and refresh the page and you're getting numbers and calculations at that instant, and the real time is $120 per month. We do also offer historical tools, historical backtesting, search tools that interact with our search tools, so you can run a search based on your criteria to see how your search would have performed over time. And of course the historical option chain, we saw that on eBay today. We jumped back to the June 5th prices to build that first spread as well. And you can add the backtesting tools. Our data goes back to April 2006. You can add that for the historical service. Add the historical tools to the 20-minute delayed service, which would go up to $40 more, $100 per month for the 20-minute delay plus historical, or $160 for everything there as well. All right, there's still other education and free stuff available. Remember, you can go to blog.poweropt.com to see some of our most recent articles that we've written, questions usually that come in from customers, similar like today. We get a question from a customer regarding a strategy that we feel is very useful. We usually end up turning that over into a blog post. Our webinar page, I shared that link with you earlier. You can go through the PowerOptions Tools webinar archives, the Options Strategies archive, Options Concepts, and the fourth category on the webinars page is Requested Topics. That's where we post our Friday discussions. So today's discussion will likely be posted tomorrow if I don't get to post it this evening, which I might do as well. Remember, you can also check us out on YouTube. Just look for PowerOptions, search for PowerOptions on YouTube, youtube.com/user/PowerOptions. Most of our archive videos are there. Whoops, sorry as well. Forgot to change the screen, that's why I flipped over it real quick. We're going to have a series of webinars next week as well. On Tuesday, we're going to be talking about radioactive trading. We're going to be talking about some of the spread trades that we use in that context of the stock and put combination, which can greatly outperform your standard covered call trade or selling a call against a married put. We're going to look at the income method number 5 and 6 examples, how they can outperform covered calls. On Wednesday, I'm going to be showing how a deeper look into using these search tools to find the positions you want and some of the other tools to help you find long calls and long puts, a specific signature tool called the Long Option Finder to help you find the best long call or long put based on this, if you know a stock and you're looking for a target price on the stock as well. Thursday, we've got a members-only session for Fusion members and Blueprint owners, and then Friday we'll be back here at 4:30 p.m. Eastern Time for our open forum Q&A session where your questions are always welcome and I always enjoy them. So you'll be able to register for those at PowerOp.com in the free webinars. You'll also be seeing an email from me as well coming up in the near future with our upcoming events. If you think of another question you didn't get to ask today, just remember you can send me an email anytime to support@powerop.com, or you can reach me at support@radioactivetrading.com if you're interested in those married puts, protected positions that you can eventually convert to bulletproof status. Remember, you can also call us during market hours. Number's 302-992-7971. And of course, if you are a current trial member or subscriber to Power Options, when you log onto the site, underneath the main home tab, click that free coaching tab, and you'll be able to schedule a session with either myself or Ernie, where it's essentially a 40 to 45-minute phone conversation, and we'll walk you through the tools on the site or answer any specific questions you have. It's not a sales call. We just want to make sure that you're going in the right direction with using the tools and see how powerful they can be to help your performance and your portfolio. Well, ladies and gentlemen, thank you again for joining me this afternoon. I hope you all have a fantastic weekend, and for those of you who are fathers, happy Father's Day, and for those of you who are mothers and weren't here a month or so ago, happy belated Mother's Day as well. We will see you soon, I hope, online. So take care, everyone. Have a great weekend. Good night.